Markets are breaking new all-time highs everywhere you look. Today on August 4th, the S&P 500 and the Dow Jones both hit all-time highs today. Palantir jumped 17% and Caterpillar went up 12% on the back of what's expected to be a 77% jump in CapEx spending in the AI sector. Guidance is giving us $725 billion of spending this year in 2026. Now, on the other hand, the 30-year Treasury yield is 5.2% today after 27 straight sessions above 5%. The U.S. national debt is currently at $40 trillion, and tariffs are the highest since 1969. Our next guest, Mark Thornton, is saying that above 5% and we're reaching danger levels in the economy. Dr. Thornton is the senior fellow at the Ludwig Von Mises Institute, and he studies patterns that repeat every time an economic boom reverses. He's written many books. Among them are two relevant books to today's conversation: Tariffs, Blockades, and Inflation in 2004, and The Skyscraper Curse and How Austrian Economists Predicted Every Major Crisis of the Last Century in 2018. His recent work focuses on how cheap credit funds the biggest national project at the very top of a boom cycle. So are we at that top now? Mark, welcome to the show. Good to see you.
It's great to be here with you, David.
I want to examine your skyscraper index. Tell us what it is, how it works. We've put together a list of skyscrapers and their completion dates and what has followed. So the Singer Building in MetLife Tower in New York completed 1908 to 1909, during which time there was a panic of 1907 economic crisis. The Chrysler Building completed in 1931. That was during the Great Depression. World Trade Center and Sears Towers in Chicago in 1974. Right after that, stagflation in the 70s. Petronas Twin Towers in Kuala Lumpur, Malaysia in 1998. That was in the middle of the 1998 Asian financial crisis. And the Burj Khalifa, completed in 2010, followed the 2008 global financial crisis. So not an exact correlation here as to what follows, whether or not it leads or coincides with the financial crisis, but there does seem to be a pattern. Can you just outline the economic theory?
Yeah, it's a pattern that's recognized by Austrian economists, but it's really perplexing to anybody else. But basically, when a new record-setting skyscraper reaches a record-setting height in terms of livable space, it coincides with the onset of a global economic crisis. And that seems crazy, I know, but basically within the Austrian theory, we pay attention to things like technology, capital and financial structures, and most importantly, the impact of artificially low interest rates on investment and stock markets. And so all of these periods were periods in which there were substantial periods beforehand of very low interest rates, where the economy was in a growth pattern and then ultimately a bubble pattern. And that's when these skyscrapers were initiated, where they were built, and they coincide roughly reaching that record height and the onset of a global economic crisis about the same time. And so for us, it's an illustration of this holistic Austrian theory, because we think that these artificially low interest rates specifically do alter the capital structure and financial books of firms throughout the economy, and that these ultra low interest rates also induce the new technology into the economy faster than it would normally. So you get a lot of high-tech innovations. And in building a world record-setting skyscraper, you have to come up with all sorts of brand new technologies from the ground up. Everything that you do to design, build, all the machinery, the elevators and escalators, the water systems, the sewer systems in these buildings, they all have to be brand new devices in order to achieve those record-setting heights. And so we see it as a great illustration of our business cycle theory, which pays attention to the capital structure of firms in the economy and also the role of technology and advanced technology. And those are two weak spots in mainstream economic thinking where they have a tough time dealing with technological innovation and changing capital structures within firms and within the economy. But they think it's all important. They just don't handle it very well in terms of what causes abnormal changes.
Perhaps maybe another way to look at it is skyscrapers are financed with not just equity but debt. And so liquidity has to be available to construction companies and developers alike. And that liquidity is usually available during a time of a boom when perhaps there's easy monetary policy. And of course, it takes many years, in some cases even a decade, to complete the skyscraper. And so by the time it's actually done, perhaps then the economic expansion is over and we're now looking at a period of monetary contraction. Perhaps that makes sense as well. What do you think?
Yes, that makes perfect sense. It's, the real estate market drives the fact that, land becomes more expensive and you need to build taller in order to make buildings profitable. So the lower interest rates also, force up the price of land, particularly in business center districts. And when the price of land goes up, you inevitably see buildings have to be built ever higher in order to make them pay off. Now, nowadays, right now, with the data centers, you notice that instead of trying to build skyscrapers to house these data centers, they're putting them out in very rural areas so that they don't have to build higher. But usually in business, especially with skyscrapers, you want them in the downtown business district.
Yeah.
And so it works with capital, it works in banking and all that, it works with technology, and it works with what we all really know about the real estate market in general. The AI data centers are an aberration to a certain extent from that tripartite causal factors.
One thing I've noticed after interviewing so many investors, economists, and market analysts over the years is that experts rarely ask themselves, what should I buy in the very beginning of the investment making decision process? In fact, they actually begin the process with a different question altogether, which is why would I own it? Before they allocate capital to any asset, they want to understand the role it plays in a portfolio, the trade-offs, and whether it aligns with their long-term goals. And I think that's a pretty thoughtful approach. So if you've been hearing more discussions about physical gold and silver, and you're wondering whether or not they fit into a long-term financial plan that's right for you, well, it's worth taking the time to understand how they work before making any investment decisions. And that's why I partner with Augusta. Today's sponsor, Augusta Precious Metals, has an experienced education team that offers personalized one-on-one educational web conferences where they'll explain the different ways people own physical gold and silver, including how purchasing precious metals is different from owning a gold IRA. They'll help answer your questions and help you understand your options better. Whether you ultimately decide precious metals are right for you is entirely your decision. So if you'd like to learn more, visit lintrustgold.com, link in the description down below, or scan the QR code here, or text LIN, L-I-N, to 35052 to request Augusta's free guide. Remember, the best investment decisions don't come until you start to understand why you should own something. Well, right now, we don't. Another equivalent to the modern day skyscraper is the AI data center. Yeah. And I'll just show you this article. These aren't skyscrapers per se, but they require a huge amount of capital expenditure. Google, Microsoft, Meta, and Amazon CapEx spending to hit $725 billion in 2026, up 77% from last year. The headline reads, analyst says bear thesis is quote unquote garbage. All right. I'd like you to maybe put this into context for us as to whether or not we can apply the same analysis to AI data centers and CapEx in the tech space, and whether or not a bear thesis formulated around this is quote unquote garbage.
Yeah, absolutely. See, and when you go to AI data centers, you're not really worried about the technology of constructing buildings anymore because data centers are not location dependent. They can obviously be built anywhere, but there's, of course, the technology component is what's inside the data center. So it doesn't really stray too far from the Austrian theory. It does stray a little far from the skyscraper index, but it's all very much in line with the general Austrian theory. And so we have seen this cluster of building of data centers, and we're going to eventually see a cluster of entrepreneurial errors when these data centers are not profitable, going forward, and for a variety of reasons. This is the most irrational process I think I've ever seen. It's not. It makes it clear to me. I don't really know. I don't study data centers, but it seems clear to me that the reason from the data centers must not be solely or for business productivity. It must be for some other reason that these things are being built, because it's not really for business productivity. It must be some government angle there. So, and of course, booms and bubbles, we recognize that data centers and artificial intelligence are basically a good thing, even if they've come too far too fast for current circumstances. They're going to be fine. They're going to be, they're going to be useful to us. They're useful to me right now. That's not the point. It's a matter of timing and capital structure and business modeling that makes sense, and the fact that it doesn't make sense when the central banks make credit freely available. Just like, in the tech bubble, all the software that was being created, all the computing power that was put together, and all of that, that was something that was good and productive and outlasted the crash in technology stocks. So we're not saying that, artificial intelligence and data centers are inherently bad or inherently inefficient. We're saying that it's related to the speculative behavior of an economic bubble that is created by the Fed with below market interest rates, and that if we had market determined interest rates, that things like booms and busts and bubbles in the stock market and elsewhere in the economy, like housing, would not take place.
Yesterday, 25 states sued the Trump administration over new tariffs. They've argued the administration used Section 301 to recreate tariffs the Supreme Court already struck down back in February. So I'll just pull this news up here and I'll leave it on the screen here. According to the CNBC report, a coalition of 25 Democratic-led states sued the Trump administration on Monday over tariffs of 10 to 12.5%. The complaint filed in the U.S. Court of International Trade challenges tariffs of 10 or 12.5% on most imported goods from the affected economies, which together account for 99.4% of U.S. imports. Is this just a political act? Is this theater, or is this the end of Trump's tariffs? What do you think is happening?
Well, it's definitely a political act. Tariffs are a political act of hostility towards our friends, and the repeal and refunds are actually a clear sign that it's domestic consumers, Americans, were actually paying the cost of those tariffs. As much as President Trump and others protested and saying, no, the foreigners have to pay the whole thing, and they are hurt by the tariffs, but it's American consumers that actually have to pay them. And right now it's part of a political theater. It's part of revenue dependency that the Trump administration has adopted from this tariff monies where they want to keep it going. They want to say to their political supporters, the special interest groups that support them, that they're still at it in terms of trying to provide special directed economic protection for American companies.
But do you think that the Supreme Court ruling that struck down Trump's tariffs, is that the beginning of the end of more tariffs to come?
Well, I certainly hope it's the end of it. Obviously, this is going to play out politically and judiciously in the courts, but I think that Americans have firmly said that they do not like these high tariffs. They know that they're paying for it. The refunds make that rather obvious, even though they're not going to be getting the money largely from the tariff rebates. And, you know, the consumer sentiment results and the opinion polling regarding the American government and President Trump, those all went down significantly with the tariffs, as did the stock market. So everything about this, the stock market and the wealthy, the average consumer, and the average voter all said no. And of course, because it's a very politically connected policy directed at a few special interest groups, President Trump wants to continue that. He wants to continue that as part of his political platform. But I think the writing is on the wall. And the politics of it is even further underlined by the fact that the states who are suing President Trump over the new round of tariffs are almost all Democrat-run states rather than Republican. So it's obviously something that the political classes are doing and enjoying and giving out favors to their friends. And it's something that hurts the average American, and it hurts our friends overseas. A political act of hostility that is causing antagonism with our friends and relatives overseas and former friends. You know, America was, for the longest time, a very admired place. And President Trump, in his tariff implementation, was a big setback to the way foreigners view America and American politics.
Well, the refunds are happening now. Amazon says it got $600 million. I believe Apple also got some money. A Seattle class action lawsuit, though, says that consumers who paid the higher prices are now owed it instead. Online, it's being called a corporate windfall. In this article, it does say that Amazon promises to pay back some of its refunds to consumers. Now, do you think that this essentially is a correct reading, that this is a corporate windfall? And if so, can we expect margins to expand and earnings to reflect this windfall next quarter?
Well, they may have already reflected those windfalls, and that may actually reverse a little bit. But, you know, a lot of things sold through Amazon, especially the bigger ticket items, the tariffs for those imports were paid by Amazon sellers. And so Amazon doesn't get that money. It does get money where it's clearly defined that Amazon, as a corporation, imported those goods from overseas and sold them directly to American consumers. So the American branch of Amazon is going to get the biggest check from the government. But of course, it's very difficult and it's going to be time consuming and wasteful, of course, for Amazon to try to figure out how to disperse all of that refund money to its consumers. Now, it's my understanding that it's going to be able to accomplish a great deal of that in terms of identifying the people who are ultimately owed the money. But it just shows you the complexity of international trade, and the paperwork that's involved is quite substantial. Now, I know Amazon has got very well-developed policies for creating refunds and very strict processes of what qualifies for refunds and that sort of thing. So I do expect a lot of Amazon customers to be notified by Amazon of the status of their account and to receive refund checks when the goods that they were buying were actually imported by Amazon itself rather than Amazon sellers.
What do you think are the biggest risks facing markets today, if not for tariffs, which were, a big concern last year?
Well, I think there's massive amounts of risk facing the American economy and the American consumer, American households. There's a whole classification of risk around the business cycle. I think we're at sort of the end stage of a very long and vast bubble in the stock market, which has been enhanced by below market interest rates. And now, basically, interest rates are, in real terms, adjusted for inflation, near zero. So we're seeing, over the last quarter or so, a big blow-off top in stocks. So I think there's that risk. I think there's risk, of course, associated with the war in the Persian Gulf regarding a lot of commodities that go into a lot of basic industry, in particular diesel fuel and jet fuel. Diesel fuel that makes it possible to transport parts and raw materials around the economy, and then to have the goods, the final goods shipped around the economy, as well as all the farm production and transportation in the economy. That's all going to be adversely affected by what are already high prices for diesel, which I expect to go much higher because of the bottlenecks caused by the war in the Persian Gulf area. So, and then, of course, there's underlying all of that, which I don't think most people or even analysts realize, but we have a structural energy problem around the globe where we've de-emphasized fossil fuel and nuclear power for several decades, and we've incentivized, non-traditional fuel sources so that we've decommissioned nuclear power, we've decommissioned coal-fired electric power plants, and we've really put the screws to oil and natural gas exploration. And as a result, what we look at right now has been a relatively low and stable price of oil, setting aside the Persian Gulf War. But what we're actually seeing beneath the surface, literally, is that a lot of the older oil and natural gas fields, their output is falling rather dramatically, and that fall in output is expected to continue. And there really hasn't been a lot of investment in the United States or the world economy in fossil fuels, in commodities of various sorts, and in many, many things like refinery of oil and natural gas and other related products that we use. And so those three areas, I think, are unrecognized but substantial risks going forward in the American and, of course, therefore the world economy.
Mark, your 2004 book called Tariffs, Blockades, and Inflation examined how tariffs impacted the economy in the Civil War era of the 1860s. Can we draw any parallels today to the 1860s and whether or not we're seeing a repeat of what happened to the economy in the Civil War era?
Well, I think exactly. I mean, Ludwig von Mises, the namesake of the Institute, and Austrian economics in general with respect to tariffs and protection policy, we first and foremost see it as a policy of hostility and antagonism, where you're essentially attacking other states or other countries politically and economically rather than just militarily. And in the case of the American states, the Northern Republicans implemented very high tariffs on imported European manufacturing goods in order to protect their special interest friends in Northern manufacturing. And the Republicans wanted to finance some of their pet projects, and this was all to be paid by Southern farming and agriculture as a result of these tariffs. And so that was an obvious and direct hostility, and it led to secession on the part of several Southern states. And ultimately, Lincoln wanted to enforce the revenue collection in Southern ports, and war broke out. And so, and the same thing happened in World War I. Protectionism sort of thing led to hostility, and then military confrontation. And I think in this case, we have a small snapshot where President Trump and tariffs and protectionism created not only the hostility with all of our friends and enemies around the world, but it also created a sort of attitude on the part of the United States, a kind of economic Napoleon complex where we could do anything we wanted to. And we saw, the invasion of Venezuela and threats against Greenland and threats against Cuba, and then these actions against Iran. And so we often see these historical parallels where the same political mindset and the same political policies lead us into a situation such as military confrontation, where certainly the voters, but even the politicians, lose control of their destiny. They get caught in this escalation process where they don't have any good choices. And certainly the U.S. and President Trump have no good choices except to concede defeat and withdraw. And that's highly unlikely, of course. And as a consequence, we've lost our control, our will over our own destiny, and we've put the future of the world economy and even the current state of the world economy, because the situation in the Persian Gulf is hurting not just Americans, and I expect the pain to increase significantly, but also people around the world in Asia and China and India and Turkey and just all over the world. People are being hurt, people are being laid off, business is being curtailed because the fuel is not there. Farmers are having to go without diesel fuel and without fertilizer. So there's a looming agricultural crisis in the next couple of crop rotations. So, these things spiral out of control. And one of the biggest causes of that spiraling out of control is the tariff issue, which seems so easy and straightforward, and where the politicians can say the foreigners are going to suffer, the foreigners are going to pay, but ultimately everybody pays the price.
Tell us more about this looming agricultural crisis. I mean, can't farmers get their fertilizers from somewhere else?
Yes. I mean, there's here in the United States, there are domestic sources. Some of it's produced through natural gas, refining. Some of it's mined in terms of phosphates and so on. And some fertilizers are still, pretty well abundant. But of course, fertilizer is something you need in a balanced format. And the price really hasn't gone up all that much so far, but the supplies of them have dwindled greatly, and farmers in third world countries and second world countries are very sensitive to changes in price, and also they just may not be available in certain markets. So they have less fertilizer going into the previous planting season, probably the same thing for the next planting season and so forth. And now they're also facing the higher price of diesel fuel, which is used in all transportation by truck, and it's used in all farm machinery. So farmers are really feeling the pinch, and I think that's going to be particularly true in third world, second world, Asian economies, all those groups who were caught off guard by this whole thing and don't really have a lot of alternative sources of supply. I mean, India and some of the Asian economies and some of the East African economies were wholly dependent upon Middle Eastern fuels, chemicals, fertilizers, etc. But of course, the problems are going to be worldwide. It's going to affect everybody. Diesel fuel could be in short supply. We could not only face higher prices for diesel fuel, higher ticket prices, lower profits for the airlines, but there may be just complete shortages where routes have to be canceled, flights have to be delayed, and so on. So it's very, very complex. I mean, I did one episode of my own podcast where I looked at the refining process of natural gas in Persian Gulf refineries. And because they have so much energy, they have a comparative advantage in producing a lot of byproducts right there in the Persian Gulf, which isn't happening right now. And one of those things is sulfuric acid. And sulfuric acid is not much of a home product anymore, but it's used in a lot of industries, and it's used in the mining industry for the refining and processing of a lot of important metals like copper, for example. And copper is in tight supply. It's at an all-time high price right now, and it's in very high demand by AI and data centers, and now in the Chinese, even in the Chinese solar panel industry, they're switching from silver to copper. They're in the process of doing that because of the high cost, and now they're finding out copper is also high price. So there's a lot of very complex things going on that you can't expect the average person on the street to be familiar with. But they will, of course, be familiar when they face higher prices and shortages of these products, including food on the grocery store stores in the United States, as these crops in coming crop years are diminished worldwide.
Going back to tariffs, how likely, just based on historical precedents, how likely will tariffs lead to a hot war?
Well, I think that they, have contributed to it in this case, because it's certainly encouraged President Trump's attitude towards foreign policy. I mean, it was, tariffs. He kind of got slapped back initially, and then he went on this spree of belligerence towards foreign economies. And in particular, of course, this is a lot of it's targeting the oil industry and people who supplied China with oil production, like Venezuela. And so, we're also, I haven't mentioned it yet, but a lot of these things are threatening China. The going into Venezuela, taking control of their oil industry was a direct threat to the Communist Party in China and the Chinese economy. And going into Iran, which was also a friend of China and a major supplier of its crude oil, which it refined into a bunch of byproducts as well as gasoline and so forth. So, this process can pan out for a long time. But even if we could solve the Persian Gulf problem and get things working again, we've already been slapping people in the face. And, when you slap people in the face, the sting does go away, but we remember those things and we don't forget those things. And they matter greatly towards future decision making. So if we wanted a more peaceful world, a more cooperative world, a more prosperous world, we've done something that's harmed our potential for achieving all of those goals in the policies that we've seen in 2025 and 2026.
Dr. Thornton, can we talk about the Federal Reserve now? You've commented in other media that the nomination of Warsh is not great for precious metals. What are you implying here? That he's possibly more hawkish than the markets expect, and that interest rates are rising with near certainty here?
I think that he would be more dovish if he could get away with it. But right now, the Fed is caught between a rock and the hard place in that, the interest rate on the 30-year government bond is very, very high. It's broken through 5%. The interest rate on the 10-year government bond is up at a very high level compared to the last several years. And they're very worried about those interest rates because of its impact on capital expenditures in the United States and the stock market. And of course, the American people will blindly follow anybody that gets the stock market going ever higher. And they know that. And that's why they say the things that they do and do the things that they do. And but the problem is if the Fed cuts the short-term interest rate right now, that's only going to put increased pressure, upward pressure on the longer-term rates because of the price inflation that's already in the system. As I mentioned in my opening remarks, the real interest rate in the American economy and indeed in the world economy, because this is a general central bank problem right now, if you adjust the actual rates for the rates of inflation, the real component of interest rates, the amount of return after inflation is very, very small. That helps the stock market because people can, like AI companies, can borrow zillions and zillions of dollars because they think that they can repay these loans with depreciated dollars. And the federal government, hopes it's going to be able to repay, make payments on the national debt in depreciated dollars. But going back to gold, I think it's pretty clear, even though I was and most observers were thinking that the precious metal market was in for a very steep correction sometime in January as the market just went hyperbolic. But you notice that at almost the exact moment that President Trump announced the appointment of Kevin Warsh, who was considered the most hawkish of all four of his nominees that he was considering, that sent the market for precious metals tumbling almost to the lowest level since the end of January. And then the market for precious metals eventually started to recover, and then it collapsed again when Trump launched the attack on Iran, killing their holy spiritual leader and the leadership of the political process in Iran. So I think the fact that those two events, which were politically determined in the United States, it's rather obvious that they were trying to take our eyes away from things like inflation and devaluing dollar and things of that nature by changing the news cycle, changing the information that's fed into artificial intelligence and into mainstream journalism with those two political acts, appointing Kevin Warsh as the chairman of the Fed and launching a devastating attack on the spiritual leader of Iran and the political leadership of Iran. Those events are all completely tied together, and I think we're only now sort of bottoming out with respect to the implications of those two acts.
How high can the long end of the curve go before the Fed is forced to raise rates or intervene in some sense?
Well, I think they're going to try to use financial repression, and that means the Fed is going to come in. That would mean, if that's true, if my guess is true, that would mean an expansion of quantitative easing. And that means where the Fed directly purchases government bonds from the market to suppress interest rates. And specifically, I think they would be making purchases from the long end of the curve in terms of 10-year and 30-year government bonds and anything in between there as well, to suppress the longer-term interest rate, because I don't think a cut in the short term, the federal funds rate, would have the desired effect. I mean, they'd like to see that lower too as well, but I don't think that that would have a desired effect because it would signal to investors that the value of the dollar is going to fall faster than it otherwise would have been falling, and that's going to put upward pressure on the long end of the yield curve, those 30-year government bonds, which they're really not issuing many of those longer-term notes. They're trying to restrict the supply of those instruments so as to keep a lid on the prices and a lid on those interest rates. So I think it's a very, very difficult path that Kevin Warsh is walking, and I think it's going to be generally a policy of financial repression, which I just described. And I think also he's going to try to get to the target rate of inflation, which they haven't done in over 5 years, by simply redefining the statistics. That's been the last refuge of central bankers, that when they can't actually make markets behave the way they really want, then they just change the information that's being put out. In this case, statistics. They'll just remeasure consumer prices so it appears that they're closer to the 2% target. And of course, Americans don't want a 2% target. They want a 0% target. And they're very, very upset about the fact that we're at 4 or 4.5% right now, and that Americans have been experiencing over 5% increases in consumer prices over the last 5 years. They're registering that in public opinion polls against the government, and also consumer sentiment that you just went through recently on your show, where we've come off of the bottom in terms of consumer sentiment, but we're still at very, very low levels. And it's it's a tripwire right now that if things don't improve, that's going to deteriorate. And if things actually deteriorate in terms of price inflation in the economy, consumer sentiment, and many of the other measures of the economy could turn sharply negative.
I think you were referring to yield curve control, buying bonds to control the long end of the curve from going up further. The last time the U.S. did that was during World War II to stop bond yields from becoming too expensive. Why do you think the government hasn't really done that since 70 years ago?
Well, I mean, in World War II, they could get away with it because patriotism was running very, very high. Sneak attack and all the horror stories and so on and so forth that the American people were working under made them very patriotic, and they were committed to the cause and all the rest. But, it wasn't to their benefit to have the interest rates on those government bonds very low and not really even covering the cost of price inflation that was being generated by the Fed. And of course, that even got worse after the war when they had to unleash the program and price inflation worsened still further. Those government bonds that people were buying patriotically turned out to be poor investments. And so, it's not a policy that in retrospect is very well liked. In fact, in the short run, people don't even know what's happening. They're only paying attention to the market rate of interest, not the after inflation rate of interest. And right now, Americans have a huge amount of money in cash savings. And so, there's a lot of cash out there that the government is using and American businesses using right now. And that's where, it's highly likely where our central bank and central banks around the world will see as a potential source to dig out a sneaky, concealed form of revenue or financing, I guess, is the best way to put it. And so it's not a very well liked policy, but it's really an act of wartime desperation. And I think the American government has put the American economy backed us into a situation of desperation with the national debt and the interest that is accruing and has to be paid on the debt. And of course, the ongoing $2 trillion of deficits and the massive amount of federal spending. I mean, there has been no cutback in government spending through all the massive increases that we've seen repeatedly year after year. And of course, that's another thing the politicians don't want to do. No one is even talking about that. In a normal government, under normal conditions, cutting budgets is a regular thing. Certainly in the United States, it's a regular thing at local governments and state governments that have to balance their budget, but it's not even being discussed currently in Washington, D.C. by our national representatives.
The Austrian business cycle theory is one of the schools defining ideas. It broadly states that our artificially low interest rates can create malinvestments in unsustainable boom cycles. Tell us about whether or not that's actually being realized in real life today after nearly a decade of zero interest rate policies from the Federal Reserve in the 2010s.
Yeah, I mean, it's been going on a long time. The Austrian business cycle theory gives us a great explanation for the business cycle. It gives us a great description of the contours of a business cycle, but it doesn't help Austrian economists really define or predict magnitudes or timing of these events. So we come up short with respect to that. So, for example, I've been saying that the American economy is ripe for an economic crash for several years now. But not that it was going to crash a month from now or a year from now, but that it was ripe for an economic crash because of the malinvestments that had taken place. And what we cannot also control is the fact that the Fed can come in and reliquefy the economy. I was predicting an economic crash related to the skyscraper curse in 2020. And, well, it didn't happen. We went into recession. COVID appeared mysteriously in the world economy, and central banks, including the Federal Reserve, injected trillions of dollars in spending. And we blasted right through that whole phase. And then a couple of years later, the economy was weakening, the consumer was weakening. It looked like a recession for sure. But behind the scenes, the Fed was transferring $2.5 trillion from the repo holdings that it possessed back into the economy. And so most people didn't know that, or they didn't recognize that. I didn't know that initially until I went digging and found that $2.5 trillion. It's hard to imagine, that I found $2.5 trillion on somebody's books, but that's what was happening and keeping that market alive. And then, of course, we were expecting the same thing to happen in 2025. But at the end of 2025, the Fed announced it was going to renew quantitative easing, $40 billion a month, in order to provide liquidity to the private equity and private credit. I had been talking about private equity and private credit on my podcast as a likely candidate for the next black swan event. And then the Fed comes to the rescue. Eventually we get higher prices, but the Fed, of course, will bail out the economy as long as it's able to. And eventually it's going to run into a brick wall, but it does have a long leash, in this case 16 years of a boom, and we don't know when that leash is going to run out, and market tolerance for this kind of behavior is going to come to an end. That's why, the long interest rates and the value of the dollar, why those things ultimately matter, because they're measurements against all investments. And it's very difficult to rig the value of the U.S. dollar and the interest rate on long-term government bonds, which is a proxy for the cost of capital in markets, stock markets, and in business markets. So, again, Austrian economists, we have almost no tools available to us to predict exact timing or exact magnitudes that, so many people want to hear, including ourselves. But at least we know what's coming, and we can understand the process. And that's very good assistance for things like long-term investment planning, and also the longer-term outlook for the stability of the American society and its political system.
How would you evaluate the Fed's ability to make policy based on data today? In other words, do you support what the Fed is doing and how they're reacting to economic data? So Friedrich Hayek once argued as part of his core thesis that it's difficult for any one central authority to gather all and aggregate all economic data available, because economic data by nature is decentralized, it's always moving, it's tacit. And so he calls this the knowledge problem. Can you just explain what the knowledge problem is and whether or not the Federal Reserve is approaching this, in your opinion, the right way?
Well, that's another thing about Austrian economics, and that quote from Hayek actually brings that out very clearly, is that we have, in some sense, we have sympathy for the central planners. And, the central bank is just a particular kind of central planner, and that all socialists, whether they're Soviet or Chinese communists or whoever they are, they don't really know. They don't have market input data that's coming to them that they can accurately gauge and magically make the right decision as to how many shoes to produce, or what colors of shoes to produce, or what kind of soles the shoes should have. They have no feedback mechanism for answering the questions which actually determine human happiness and satisfaction. That's why, Mises was right 100 years ago that we don't want society run on the basis of central planning and a socialist rule over the economy, because all the regulatory bodies in the United States, and especially the Federal Reserve, is just that. They're a bureaucratic planning operation that is trying to price control its way into controlling the American economy. It's just not feasible. It's just not likely to happen. Now, of course, occasionally things seem to work out okay, but they would work out much better in terms of the productivity, long-term capital investment, entrepreneurial uncertainty, if we had a monetary system based on a commodity money like gold, which was independent, completely independent of any kind of bureaucratic decision making. And so very often questions come up, in economics about, well, what's the true rate of interest, or the natural rate of interest? And then a thousand economists will go try to estimate what the natural rate of interest is. And you can't get to it because only the market can really determine these things. And, and that's why we have sympathy for the fact that central planners, just like at the Fed, are constantly making mistakes. Both small mistakes, which are not really brought to people's attention very often, as well as the larger looming mistakes that the Fed has faced in the past and is guilty of in the past, and which it's facing right now. I would say the Fed is very much in a catch-22 position, a very highly constrained position. Sometimes things are easy for the Fed. Sometimes things are hard for the Fed. I think conditions right now are extremely hard for the Fed, and that they do not have many good options.
If you look ahead at what the Fed is doing now, what can we expect from inflation as a result of the Fed's current monetary policy, and ultimately our standard of living, which is to say real wages? Can our wages catch up with inflation as a result of what the Federal Reserve is doing right now?
Well, in theory and in history, that's the problem. A major problem with inflation is that, the people who get the money first, they're the big benefactors. And then when they start spending the money, other people benefit, but prices go up. And it's really the working class that really never get that money in their pockets. They just get the higher prices. So wage rates typically on a macro level only increase at the end of the inflationary process. So I'm not optimistic with respect to price inflation. I think it's going to be high. I actually think it's going to be higher. I think it's going to be led by some of the products that I've featured, including diesel fuel and jet fuel, chemicals, and so forth. and higher agricultural prices. So, the central bank always wants to exclude food and energy, and I think those are the two categories that we could see the most significant increases going forward. Other prices, in terms of assets, I expect less growth. I expect the prices of stocks to not go up much at all. I mean, if you compute them on the basis of a 10-year moving average, the net expected return in stocks over the next 10 years is 0 or negative. I expect the return on bonds, both corporate and government, to be, adjusting for inflation, to be 0 or negative over the next several years. And I only think, and real estate is the same way because of all the investment in there. The expected returns are going to be low, and I think we could see a lot of price decreases in stocks, bonds, and land prices in particular. I think land prices are going to go back into the closet where you're not going to see much in the way of transactions for land. And so, some prices are going to go down, but the consumer basket prices are likely to head higher.
Okay, thank you very much, Mark. Appreciate your time and analysis today. Where can we learn more from your work?
David, it's been a great pleasure, and I'm at the Mises Institute. You can find us at mises.org. And if you go to our homepage, there'll be a link at the top of the screen where you can pick up a free copy every month of one of our books. And this month's book is by Murray Rothbard, our first vice president for academic affairs. It's called The Case for a 100% Gold Dollar. And you get a copy or maybe multiple copies of that book for free just by writing us using the link at the top of our homepage.
All right. Appreciate your time. Put the link down. We'll put the link down in the description down below so you can follow Mark's work there. Thank you very much, Mark, for joining the show, and I look forward to speaking with you again soon. Take care for now.
Thank you, David.
And thank you for watching. Please do like and subscribe and follow Mark Thornton in the links down below.